So when it comes to life insurance, mate, because one thing that we hear all the time from so many critics of life insurance, the first thing they tell you is don't put your money in life insurance. Life insurance is a bad investment. They tell you, life insurance is only good for death. You need to buy term insurance. You need to just buy term and invest the difference. We hear that a lot from a lot of people. But then the next advice they're going to give you is they're going to say, well, when you invest different, you need to put 6 months emergency money in a savings account at a local bank. You need to invest your money in the stock market, which is sounds great until we start peeling off the oranges or peeling off the peel from it and saying, listen, when we look at life insurance, one, life insurance is the only product in the industry where the insurance company is saying, one, I'm willing to give you, you give me your money, I'm going to give you interest rate on it, and I'm still going to protect your family just in case you die. But at the same time, you have some tax benefits attached to it. Now, let's look at the bank for a second. If you're telling me that I need to put my 6 months of emergency money in a local bank at a savings account, so I take my money, I've done everything you said, and I'm putting $20,000 in this local bank, well, first, the interest rate the bank is going to give me is what, 0.1% or even nothing. And then at the same time, what's the bank going to do? They'll take my money and they're going to loan it to somebody else on a credit card, charge that person 18% interest rate, loan on a car note, a car loan, 5% interest or 4% or whatever it is, depending on that person's credit, or even on a mortgage. But then they're giving me back 0.1 and then they don't even protect my money. So if something should ever happen, somebody should sue me and they could put a credit lien on my money that I'm supposed to use for emergency. You put a credit lien, how am I going to reach the money? Now, when we flip it back to insurance policies, why I love it so much is the fact that you could sue me all you want, depending on how my policy is structured. Guess what? You can't even touch the money in the policy. So I get the protection from the insurance company because it's a private contract between me and the insurance company. And two, the insurance company is willing to pay me 4 to 5% interest rate, depending on the kind of product that I put in place. 4 to 5%. Yes, they're making billions, but at least they're better than a bank that's saying, hey, we're going to make a lot. The banks make billions off of your money, but they only give you 0.1, and sometimes they don't even give you anything. But the insurance company is willing to give me 4 to 5% interest rate, and they tell me if I structure the policy properly by putting a lot of money in there, they're going to give me a whole lot more protection, like tax deferral, which means the interest I earn, I don't get to pay taxes on it. So now let's flip back to the stock market. So every time I put money in the stock market or even in a CD at the local bank, every year I got to pay interest on that. I got to pay taxes on the interest that I put in. So if I'm paying taxes on an interest that I earned on the money, how is that benefiting me? Because now at the end of the day, every year I'm paying taxes on an interest that I made. So, but with the insurance company, they're saying you don't have to pay interest. We're going to defer the interest to a future date. And then when I need my money, I can also take it out tax free. Man, you can't get that anywhere else. Now, how do you access money from an insurance policy tax free? See, that's another myth that most people don't understand. What you do, the insurance company will let you borrow the money. You take it out as a loan. Now, a lot of people frown against that. Why should I borrow from my own policy? Well, you're not borrowing from a policy. What you're doing, you're using your life insurance policy as a collateral to borrow money. So the insurance company is saying, hey, you got $100,000 cash value or $50,000 cash value. You want to go buy a car. Instead of going to your local traditional bank to go borrow the money from them, we'll give you our money while your 50,000 continues to earn compounding interest. See, compounding interest is the eighth wonder of the world. It's better than any other type of interest. It allows your money to double. So the insurance company is saying, we're going to allow you to have uninterrupted compounding interest. Uninterrupted. That means I'm not pulling money out of it. My 50 grand continues to earn uninterrupted compound interest growing, while the insurance company says we'll give you $20,000 from our own account. So let's flip it. Let's look at let's say you have a local bank A, because I don't want to give any banks props. But let's let local bank A. You have 50,000 at local bank A. You want to buy a car from local bank B. They have a better rate. You go to local bank B and say, hey, I need $20,000. They say, okay, we'll give you $20,000 against the 50. So you borrowed from the local bank, right? That's what you did. So the same thing, the insurance company is that local bank. They allow you, they say, we're going to give you the 20,000 Go buy the car you want. We're going to charge you interest on that 20 grand, but your 50 continues to make money for you. Now, here's the benefit. It doesn't show up on your credit report. Equifax, TransUnion, they don't even know you took that money out. It doesn't affect your, what they call your debt to ratio. Nobody else knew you took that money. It's a private contract between you and the insurance company. So how come all these so-called advisors ain't telling you all that? Why is it that people are so negative about life insurance? And at the same time, when I have that 50 grand in there, there's also a death benefit there that says, Douglas, you know what? If something happens to you and you don't make it, your children, your beneficiaries will receive a check, $250,000, $1 million, depending on how big your life insurance contract is. So the wealthy have been using life insurance forever. Insurance companies have been around since the 1800s. First, they control 75% of the wealth in this country. Second, they got more money than the federal government. They own more real estate than any other industry in the world. So where do you think I want to be putting my money in? With a company that is solid, that has a solid foundation. Now, don't get me wrong. We're just saying park your money there and then borrow from it to do other things. Invest in stocks if you want to, but at least you're not affecting your principle. Your foundation is solid. So those are the myths. So don't fall for that hype, because when you get to a certain level of your wealth, you want to start looking at safe stuff that will help you and at the same time protect your family. Because the bottom line is, if I'm trying to save $1 million between now and age 65 or whatever time it is, and I'm using the life insurance as that to give me that protection. So first is I put the money in a life insurance, I get $1 million coverage. Now I'm max funding it. That's another thing. You got to know how to max fund your policy, which is basically you're putting up to the maximum allowed by the federal government. Because again, why would the federal government put a cap on how much somebody puts in the insurance? Well, the reason they do that because they don't want you to benefit too much from it. So those are the kind of things that we teach, our sales rep. This is what we teach our clients, because we believe it's education. The more education you know, the more opportunity, the more knowledge you have, the better for you to be able to do stuff for your family.